Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis on Monday, December 8, 2014. Well, we had the first down day in the S&P. This is the the SPY chart. And SPY was down $1.39 today. S&P was down 15 points or 0.75%. So, as I've been saying, you're probably going to get a sell-off. Now it looks like you'll probably get anywhere from, I would say, 2 to 3 days this week, and one of them should be pretty good, maybe better than today. And then you should begin to get the light volume, and the end of the year rally will kick in as the volume gets lighter from next week forward. Into the new year, through Christmas and New Year, you should get a rally. And where should the rally go? Well, first, before we go where did the rally go, let's go where's the S&P going to go. So as it stands right now, I would look for no more downside. First level would be, call it 202. It's really about 201.85. And if we pierce through that, look for the 50-period moving average at, we'll call it 199.5. Okay, I don't see any or much more downside coming before the end of the year or this week than that. And once that happens, we're going to look for a rally into the end of the year. And whether or not we break these highs before the end of the year or not, into beginning, first part, week or so, 2 weeks of January, my upside target for the S&P, now right now the S&P is at 2060, okay? I would look for 2130 to 2135 in the S&P before this rally begins to stall out. That's my number. That's the calculation that I worked out for an upside target. Could we go higher? Yeah, we could go higher, but I believe we'll get to that number at a minimum, 2130 to 2135, which would put the SPY at about 213 to 213.50. Okay, so that's pretty good upside. Let's say we come down to this level here. Okay, that's pretty good upside. That's 13 points in the SPY from where we would expect this rally to start. Even if we stalled that at 201.85, okay, that's going to be 11.5 points of upside from that point, hopefully latter part of this week, moving forward for the next 3 to 4 weeks from there. So that's what I see. Anything changes from that, I'll certainly update, but that's where I see the upside target in the S&P 500. All right. Let's move. Well, you know what? Let's just go over to, we always talk about the IWM as my favorite proxy for the market. And as you would expect, the IWM was down today pretty good. IWM was down, the Russell, I'm going to talk about the Russell. The Russell was down 1.25% today, which was significantly more than the S&P. The S&P was down 0.75%, and the Russell was down 1.25%. That tells us that the money is coming out of risk assets. Remember, risk assets would be classified as the Russell index and the NASDAQ index. And the NASDAQ was almost down about as much as the S&P, slightly more, but not much more. But the Russell, which is small business in America, was down 1.25% today, which is a tell that there's probably more downside to come. So, we'll go from there, and each and every night I'm going to tell you what I think, and I'm going to tell you where I think the market's headed. And if we reverse higher from here, we reverse higher from here. We're not looking to short the major indexes here. What we're looking to do is we're looking to buy when we get to a target number. And what's a target number in the Russell? Absolute worst case scenario is probably down here at this 111. This gap fill here. Markets love to fill gaps, and this is a near enough gap where it could be filled this week on a sell-off if we get any kind of sell-off in earnest. Other than that, you'll probably, if we didn't get down there, you'll probably stop at the 50-period moving average. First, you'll take a stop at the 200, which is this black line here. So those are your targets: 200-period moving average, 114.25. 50-period moving average, 113, and this gap fill is 111. So those are your three numbers in the IWM for those of you that like to trade in the IWM. Let's go over to the USO and talk a little bit about the oil market because, not OSO, USO, because oil is still trying to find a bottom. Remember back when I thought $72 in the price of crude was going to be a bottom. Then we came down, blew through 70. This was the OPEC meeting on Thanksgiving. We came down to 65. Looked like that was going to be a bottom. And here we sit as we speak tonight at 62.76. We finished the regular session today, the pit session they call it, at 63.05. And then 62.76 in the Globex session right now. What it looks like to me is 60, mainly because it's a big round number. And as we get to 60, they'll be calling for 50 and 40 and all those numbers. If we don't hold 60, then you got to look to 55. It's just going to kind of go in $5 increments from there. There's some rhyme or reason to that. There are numbers. There's a 200-period moving average. I can't bring up the crude oil contract on this chart here. It's on another platform. But there's a 200-period moving average just below 55 that coincides on a monthly basis. And also the $60, basically where we are now is the 618 retracement from a low to the high of 147 we hit in 2007, and then we're retracing that, and that's where we are now. So we'll see how it goes. It's it's stupid to try and pick a bottom in crude oil right now. All the oil stocks, the oil services sector. Let's look. The XLE, and I'll tell you what I was going to say on picking a bottom. The XLE, let's go to a longer time frame. Here's a weekly chart in the XLE. You're coming through the 200-period moving average. So you have some supports here at 76, and then you have some 70, almost, let's call it 73.5. This would be a really, really good level, 73.5, because you have a pivot low here. Okay, you have a pivot high here, and you have some chart consolidation. Let's get rid of this. You have some chart consolidation here, okay? So this would provide a pretty good level of support at about $74. And that would be a really, I don't know that we get down there, but if we got down there, you could start looking at probably forming some kind of a bottom. But how are you going to know where there's a bottom? What you do is you don't guess. That's the worst thing you can do. What you do, where'd that thing go? What you do is, instead of trying to pick a bottom, there you go. Instead, what you normally would do is you look for a high volume reversal day. Okay, let's go back to a daily chart. All right, and this is the XLE. Okay, the XLE. Down here, this would be October 15th when the stock market bottomed, the S&P bottomed, okay, Dow bottomed. What you would be looking for here is something like this, where you have a tail low and you have huge volume. So, for example, on this day, the volume on the XLE, okay, was almost 70 million shares when the average volume is about 25 million shares. Okay, that would signify a reversal day. That's what you're looking for. Today you had about 41 million shares. That's not going to do it. Okay, you're going to need something like an 80 million share day, 70 million share day, and you have a nice reversal. That's what it'll tell. And you're not going to pick the bottom. You don't have to pick the bottom, because once you put in that kind of a day, you're going to have a few weeks at minimum of upside in the energy sector. So that's what we're looking for. So that's when you look to pick off some energy stocks that have been just taken behind the woodshed, beaten down twice. Okay. So that's what we're looking for in the energy sector. Don't try and pick bottoms. It typically doesn't work. You're going to pick a bottom once, but you're going to be wrong 8 or 9 times along the way. So it's a fool's game. So now let's look at GLD. And GLD had a nice little day today because what happened was, let's take a look at an intraday chart. Okay. Here's the 10-minute intraday chart, and around 2 o'clock in the afternoon, all right, about 1:30, 1:40 in the afternoon, okay, you had this, all of a sudden it just ramped up. And what that's telling you is that there are some buyers behind gold. Gold's been up and down, up and down. Let's go back to the daily chart, okay? We had a nice up move. Now you're putting in some choppy, sideways back and forth action. And then all of a sudden you had that nice middle of the day up move today. And whether or not we get some further upside tomorrow or not, I certainly think over the next several weeks, you're going to see nice upside in gold, and I would expect the GLD to get to this 120 level and higher, okay? But at least this 120 level for starters before you even stall out in earnest, okay? And the reason for that is, and I've been telling you all along, a good solid reason for that is the Central Bank of Japan is printing money like they've never printed before. And the ECB, you have Mario Draghi over in Europe, he's pounding the table. He wants to print money. He wants to buy bonds. He wants to do all this stuff. And the minute that the other countries like Germany get on board, okay, and they allow him to do this, that's it. It's off to the races. And whether it happens in a week or 2 or 3, I don't know. But what I do know is it's coming. And I do know is that gold's going to move higher. Okay, so, again, pick a bottom. It's up to you, but I think gold can be accumulated in this area. Unlike oil, where it hasn't found a bottom, I believe gold has found a bottom, and I think the next time we find a low will be a secondary low, whether it's higher from here or not. It will be a secondary low from this level down here. So that's why gold is different than oil. And also the second thing is, the dollar has been on an all-out tear. Okay, we're going to look at the UUP, which is the ETF that tracks the dollar. Now, it's even more, it's even a better picture. Okay, it's more pronounced when I look at the weekly or monthly chart. Okay, look at this move on the weekly basis. Let's just look at a monthly chart just to show you even a bigger pronouncement. Okay. All right, you see what's going on here? This is a monthly chart. 1, 2, 3, 4, 5, 6. That's 6 months in a row of earnest up move in the dollar, okay? Now, let's go back to the weekly chart because I'll show you what I'm looking at. So what we're looking at here is we're going to eventually have to pull back to work off some of this overbought condition, okay? And we're probably going to come into this pivot high here on a pullback. Let's call it 23 and lower, maybe down to this 20-period moving average. We're very extended from the 20-period moving average. Anytime a market gets very extended from the 20-period moving average, it wants to come back towards the 20-period moving average. We'll call it like coming back towards home. The 20-period moving average is like home base. Okay, once the market gets too far from home, okay, it likes to come back home and kind of give a consolidation pattern, and then it can be ready to move higher again. So if the dollar moves lower, okay, you'll start to see gold and oil typically catch a bid. That's just the way markets work over the last several years. Not every time, and But I believe that because we're near a low in oil, and I believe we're either have made or will shortly make a low in gold, once the dollar comes in a little bit and the euro starts to pop, we'll see an up move in oil, we'll see an up move in gold, and that's just another reason supporting the case, and that's really nothing more than that. But each market is independent of another, but sometimes we look for evidence in other markets, and that's all I'm doing here is showing you some evidence. Let's go back to the daily, and you can see, down coming back to the 20 period, maybe even the 50 period of this pivot high down to $23 in the USO is definitely not out of the question. In fact, this would be a great target because you have what's called a gap window. See this big gap here? Gap window, pivot high, 50 period moving average. If you saw the UUP come into this level, that would be a multi-day bounce right in front of your eyes, and you can buy that, okay? For tonight, folks, I think that's it. We're going to leave it there. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.